Hello everyone, welcome to the next iteration of the Brooks Macdonald podcast. My name is James Collier, I'm Head of Sales. Delighted to be joined by Will Hobbs, our Chief Investment Officer. Will, today we're going to be talking about a number of things that I'm sure keep you and your team very busy on our clients' behalf, not least geopolitics, the valuation of various asset classes, artificial intelligence, etc. Keen to get your views on, let's start with Iran. A lot going on there, the trade-off between military escalation versus diplomatic solution. What is your take on this in terms of where are things still mispriced and where we see things going from here?
Yes, God, good starter. I mean, James, the one sort of starting problem that I have in a way is that our industry over-indexes in armchair generals. And at moments when all of these conflicts, these tragedies start, we're never going to be short of overconfident dudes sitting around and sort of predicting what comes next. And I think the reminder from me is that when the main protagonists themselves don't know what comes next, and remember, this is a particularly mercurial US president and an administration, perhaps deliberately so by design. That's part of the art of the deal thing. We want to be wary of those who would kind of knowledgeably second guess them. There are, like you say, threats that the market is kind of struggling to price accurately, and that's not too unsurprising in some ways. One of the things that you're running into is that in order to get to a deal, some market pressure might be needed. That market pressure may well come as you run down your stocks of oil in particular, oil and gas in particular. And the closer you get, the more market pressure will increase. So that sort of biases us to think a little bit that if a deal does come, it might be a last minute deal anyway. But the fact that markets are looking through to the other side of the valley as such, it is not too surprising either in a way. Markets can be quite cold when it comes to kind of human suffering if it doesn't materially affect future cash flows. And remember that today's market prices, they're a shorthand for all of the future cash flows which people assume that the companies related and not related directly are going to generate. So in a sense, like a relatively hopefully short-lived conflict, which does quite a lot of damage in the short term, that can actually do much less damage to market prices, assuming that it does get resolved as such.
I remember back in 2011, in a former life, a senior fund manager said to me after the tragedy of the 2011 tsunami in Japan, the Nikkei fell 25%. He said, are you telling me that the present value of the future earnings of all of those companies in perpetuity is worth 25% less now? And sure enough, 2-3 days later, you saw that recovery.
Yeah.
I'm curious, when you look at implied volatility in the market, when you look at robust risk asset and equity pricing, has the notion of geopolitics, not least Iran, has it become kind of commonplace now as opposed to an episodic shock? Do you price this into how you think about the market? Is it there now?
It's a good point. So, I mean, again, there's a number of points to make. I mean, the first thing to make is that, the industry, again, has got a lot of actually not just armchair geopolitical risk experts, but actual proper geopolitical specialists. The problem we have there is one of incentives. So we're always having sort of, we have a privileged position of always getting access to incredible expertise in this industry. But the problem is, in a sense, is that if you are a geopolitical strategist and you've got a geopolitical think tank, let's say, and you're going around the city and various other places, trying to talk about the various risks, you haven't really done your job unless everyone in the room you're speaking to is terrified on exit and wants to therefore pay for your services. It's the old adage of don't go to a barber and ask if you need a haircut. If you try and put this moment in context, I think you've got sort of a number of further problems in terms of accurately contextualizing it. One, relative to 10, 20, 30, 50 years ago, we just see a lot more of what is going on instantaneously. Growing up in Norfolk, the main source of news I had was the Eastern Daily Press, where, most of the time the worst story you're going to get is tractor crashes through neighbour's fence or something similar. Now we can get real-time footage of the worst atrocity in the world happening at that moment, 24 hours a day. Now, does that make the world more dangerous? And alongside the fact that we've got 7% of the people who ever lived alive on the planet today, how do we contextualize the level of threat and the level of geopolitical risk? I would personally argue that I can think of several periods where the threat was more dangerous and the memory of worse was much worse in a sense. So you can think about the 1950s and 60s as an example I regularly use, when the persistent level of threat, i.e. World War III, was nearly stumbled into multiple times. And indeed, the sort of realized threat was much greater. So you had, Korea, where General MacArthur, asked Truman to whether he could drop 30 atom bombs on China, and Truman thankfully said no. You get Vietnam, you get the Great Leap Forward in China, you get all of the terrorist outrages that were sort of dogging Europe during the time. But actually what was driving markets and economies higher, because remember this was supposedly a glorious period for economic growth and market returns, it was productivity growth. So a lot of innovations that were coming out of the back of, all of that R&D during the war and some pre-war, they were starting to be commercialized in the aftermath of the Second World War. So actually, although you would have been it would have been totally understandable were you to be worried and thinking about the level of geopolitical risk and what that meant for economic growth and investment market returns, you'd have been wrong. Because actually in the driving seat was the productivity story. I would make the case that it could be the same again, that in a sense the geopolitical news is not the thing we really need to be paying attention to, but what's going on in the underlying economy.
We'll come back to productivity, I think, particularly around AI, but just coming back to the point about market observers, clients of ours, people in their armchairs at home.
Yeah.
When you read the press, it's very easy, certainly when it comes to the Middle East and geopolitical tensions, to look at energy and oil. But keen to get your thoughts on second and third order effects, transmission mechanisms across currency markets, fixed income equities. Yeah. How are you thinking about that?
Yeah, I mean, it obviously varies per region. So, in the UK, you can find that, the food inputs that you see quoted almost instantaneously on the various terminals, they take quite a long time to translate into higher food prices because of the contract process and various other bits and bobs. Sometimes as much as 9 months, even a year, before those prices travel all the way and start sort of taking heat out of our consumer spending. And the oil prices too, obviously, in Europe, you've got higher taxes on energy inputs, therefore the actual price rise is a smaller proportion of what's realized as the consumer impact. And also there are sort of dampeners in terms of how it's transmitted because of, again, the way we treat energy prices and the way the various energy companies transmit it to us. So the thing to watch a little bit, I guess, is that it's not so much, in my opinion, the inflationary story, but it's actually how much heat it takes out of the consumer spending story. Because actually these things, after the initial price shock, you should find that the forces are actually more disinflationary, because ultimately it should mean a little bit less consumption because consumers are having some of their pep taken out of them by price shocks. So these are the things to watch a little bit, and obviously there's lots of other potential effects, but in a way, and again, I guess this is the same point as the last point to a degree, really focusing, trying to work out what really matters to focus on as an investor is very complicated, because it's not necessarily always the thing that's top of the news feeds. What's newsworthy and what matters for investments, they're often quite distinct. And for me, again, the main thing to focus on really are the prospects for innovation, the prospects for productivity growth, how that is being translated in different parts of the world. To a certain extent, inflation is kind of a bit further down the pecking order than that at the moment.
And taking that just one step further towards the rate cycle.
Yeah.
When I'm thinking rollover of debt, I've got a matrix in my head of developed and emerging corporate and government. Is there a wall of refinancing risk here? Are we higher for longer? What's your take on that?
I think higher for longer, but again, a non-sinister reason, or potentially non-sinister reason. I would start off by saying the controversial comment that might have these guys carry me out the door with sort of, straight jackets on. But if you look through history, there's no relationship between the amount of debt and the interest rate you pay. That sounds counterintuitive, but if you look at, even in the most recent years, you can see since 2021, the US future debt profile has actually improved a great deal because productivity growth has stepped up I mean, you've taken 50 percentage points off your 30-year target in a way, but actually your interest rates have gone up quite sharply because productivity growth has picked up. So your real interest rate is pushing rates up overall higher. The idea that bond vigilantes or worries about fiscal sustainability are part of this, I disagree with strongly. And so I do think that because we're entering an industrial revolution, and because you are going to see faster growth around much of the developed world, the UK included, maybe the UK even specifically, as we'll come to in a second, that is going to mean higher rates for longer. But it shouldn't necessarily be a source of great concern, because if you're growing faster, you can sustain more debt. And to give you a sense of that, if you assumed, and I think we've made this point on this podcast before, but quite a lot of the worries about debt at the moment are really anchoring to the idea that the growth rate of the UK economy, for example, since the great financial crisis, is all that we can expect going forward. Now, that to me lacks imagination. For the post-war period, we're pretty reliably growing in 2%, in real terms, about 2%. If you assume a return to that growth rate rather than the pre-great financial crisis growth, your debt to GDP can almost disappear in the space of 50 years.
So the 10 basis point contraction, latest announcement in the UK GDP, that's
irrelevant.
Noise.
Irrelevant. Yeah. The first, the monthly GDP data is more noise than GDP data anyway. Is, I'm afraid, just very difficult. We can do a separate
gross
podcast.
National happiness or something.
It's not just that, but in a way, there's whole loads of things to sort of factor into it, but. Ultimately, you will see down the line lots of revisions to that GDP data, which tell an entirely different story. The other point really is I think that the economy is getting we're underinvesting in statistics generally. A lot of these data are reliant on survey responses, and survey responses have been plummeting lower for decades, and plunged further lower during the pandemic and have just not recovered. So the data have just become less reliable. In the UK as well, we've kind of, austerity has underinvested in these things. So GDP data, then, as a concept, it's not fit for purpose. This was designed, in the 40s to try and capture the steel and wheat economy, not whatever it is we live in now. So I can think of so many reasons why we should ignore that.
Great segue. Whatever it is we live in now, it would be odd if we didn't talk about AI.
Yes.
I was noting, and I expose my understanding of this before I pass to you, looking at super high bandwidth AI infrastructure consumption and the semis and chip providers in the East at maximum capacity. Hotspot in the markets right now, but what are the downstream implications to that more immediately and across other sectors as well?
Great question. And again, I'll say something weird and controversial just to keep this lively. I mean, so in a way, like always you find, investors, they over-fixate on originators of technology. And they understate or underestimate the impact of competition, and therefore they overstate the returns on capital by the early innovators. And that's exactly where we are now. So the sort of hype and narrative power is really focused on the kind of picks and shovels, the idea that it's the chips, the memory stocks, which are the ones that are really going to the moon, and you're seeing incredible, Korea and Taiwan and parts of the US ecosystem are just going absolutely nuts, or have been. The thing you've got to think of, as you rightly point out, is where is this technology going to be useful? What are the things that it will change? What are the areas of the economy that it's really going to impact? Now, my argument would be that if AI reaches an AR, that's a very broad term, as you know, let's say machine learning, all the sort of stuff that's already changed versus where large language models could, and I mean could, get to. And it's really the knowledge economy, the services sector, huge parts of financial services, legal services, all of that bit. Now, who are, as a proportion of GDP, the biggest service sector superpowers? The UK, the US, so in a way, I would say that the underpriced part of this trade is really the knowledge sector of US and UK and various other bits of the world, and actually we're investing accordingly, where you're finding in some parts, particularly in the UK, some quite cheap assets that we haven't yet thought about how that's going to be supercharged by a technology that, like I say, if it delivers on its promise, is going to change things.
So is it too crude for me to position AI to you as a productivity boost versus valuation concern? They're not necessarily different sides of the same coin. But
Well, no, that is definitely one way to think about it. So I would say, in a way, that the picks and shovels phase of the cycle is certainly sort of, there's some top evaluations out there. The thing I have a concern about, in a way, is that AI is becoming too broad a moniker. Just like tech is just quite meaningless now in the modern economy. It's not a dichotomy that really means much. What's a technology stock and what's not? Is Walmart a technology stock, or how does Amazon? All of these kind of things. They're sort of to varying degrees, and AI, when we talk about productivity growth, generative AI cannot really have materially boosted productivity growth just yet. Well, it might be through the infrastructure spend, but more likely what you've seen in the last couple of years is already productivity growth has been kicking up. My argument would be that that's about much wider than AI. It's about the machine learning advances of the last decade and how that's allowing companies to just tweak efficiencies, get better at using their data, start to really think about, how to reorganize processes around these more flexible, general purpose technologies. And that's already happening. So the AI stream is one part of it. It's a very noisy bit of it at the moment. But large language models, my main concern in a way is that maybe this is an off-ramp on the way to general artificial intelligence, or general intelligence as such, that actually perhaps like pattern spotting is not the way to get there. And maybe they're going to run into the same problems as we run into in the finance industry on a regular basis, is that the data is actually not that good for the most part. And unless you're a high frequency trader, you're always running into the kind of overfitting and other such problems that make plenty of sort of cul-de-sacs from an investment perspective and wrong turns generally. So I still think that kind of jagged frontier of AI is a problem, because it means that you can't implement it high enough up in terms of task, in terms of the sort of the quality and the importance of tasks, without extremely expensive supervision from humans. And so it can't take much of the thing. It can't free us up to do other stuff. We can't reorganize processes around it just yet. There are differences. You get small language models, and you get some of the other sort of innovations that are coming with it, and how they might interact with other stuff. But I think I'm bullish on a technological revolution in general, and an information revolution. I'm more cautious on the AI side of things, and that makes us a little bit selective within the US and Asian markets as a house, definitely. But that's only kind of, wisdom, I think, from the team.
I saw a great comment from an artist, philosopher, saying, AI writes my poem so I could do my dishes. I wish it did my dishes so I could write my poem. So there's a number of different ways to view this.
100%. Just on that, just remember that you and I, we don't read books or go see films or look at artwork because it's just a sort of pretty picture or in a nice organization of words. It's sharing the human experience. That's the whole point. Yeah. So the idea that it's going to take those chunks, why? Yeah. Why would you want it to?
That's one thing I think for all the viewers at home today, whether you are an active participant or I'd say a passive participant insofar as your investments and savings, is SpaceX. The Tony Stark headline, as I keep saying.
Yes.
Not so much your thoughts on rockets and satellites per se, but what the bigger symbolic picture here about AI, about mega cap domination, about the FANG type big tech stocks and further concentration in US equities, and not least the valuation. This is now going to be, at company level, a top 10 market cap firm in the world.
Well, certainly in the NASDAQ, isn't it? Because the NASDAQ doesn't free float adjust. So I think in the S&P, just because we're only getting access to such a tiny amount of the company, it means that it's sort of lower down in the S&P and the other indices. But you're now getting this quite interesting scrabble of the sort of passive indices providers to be able to buy up whatever is of the free float available. I think it's kind of an incredible story, because it sort of mixes some of the things that we're talking about, some of the positives and some of the negatives of investing. If I think about investing and the sort of cleanest pitch about why people should invest, in a sense, to me, it's a positive expression of your view of the future. I believe that, humankind will continue to make new stuff and get better at using that new stuff. And the best way to access that or profit from that is to own stock, companies, diversified access to the global economy. And so in a sense, like SpaceX represents a really interesting sort of distillation of that. Own space, own social media in space. Let's assume that Martians are going to sort of need to abuse each other at all times of the day and night, the Martian day and night. But you get to sort of some of the other problem, which is that SpaceX in particular, it is a huge bet on Elon Musk. And Elon Musk's incredible skills at industrial organization in particular. And, his many supporters will point to, Tesla and some of the sort of investment experience of that. It always looked expensive. It always looked prohibitively expensive, but turned for many years into a good investor. And so there'll be investment and there'll be people, it's very much sort of much like the rest of the world. People are divided into lovers and haters. And they're having a lot of fun arguing about it by the looks of things. But it's not for me, I have to admit, personal sort of like portfolio. I don't think I'd sort of be getting involved just yet, but it is an interesting company. It's an interesting idea. And I am an admirer of, Elon Musk's ability to organize industrial operations. I think he's phenomenal at it. So yes, we shall watch, and it is an interesting moment.
I presume, anecdotally, if you're like me or anyone else who works in financial services, friends and family are WhatsApping you saying, should I do this way?
Can I have a clip? Well, I think, it's such an interesting moment for investors because you've got a global economy which is accelerating. It's doing a lot better than people thought. Even at the beginning of the year, it's doing better. So the global economy underlying all of these investments, the outlook, all of those kind of things looks better. To that extent, interest rates are higher, and that's making people worry, and it's going to certainly create more turbulence. But in the markets, you've got bits of extra leverage. So you're seeing that in the markets. So leveraged ETFs, they've doubled in size since the beginning of the year. So there's sort of bits of froth in certain places, a lot of excitement in others. But there is still kind of like narrative consistency internally, internal consistency. So growth rates relative to prices and valuations are still marrying up, even if you may not agree with some of the growth expectations being bandied around.
So when we get back to the office and you sit at your desk and your Bloomberg screens are flashing at you, when we think of the rate cycle, we think of inflation, valuations, investor sentiment, geopolitics, and take a step back for our clients, investors at home. How do you make sense of this? What do you think in terms of portfolio positioning, the noise versus the fundamentals? What's the next step from here?
I was thinking, going back to my office, not until I've had a Shake Shack, I think, will be the most important thing. I
remember you saying that was your favourite.
Yeah, I can't wait. So yes, after a brief double patty with all the rest of it, yes, what are the team doing? And I think the most boring part of the message is diversification and focus on value. The team are very selective about where they want to play. And I think it's that mixture between, the war chest strategy where there are going to be bumps in the road ahead that you're not going to be able to predict. And so you have to make as much as you can from buoyant markets without getting carried away and following the kind of real momentum crowd and getting things, getting risks out of kilter with your wider sort of objectives in terms of long-term inflation beating returns and all of those kind of things. So diversification across asset classes. So certainly we are more interested in fixed income at these spaces. That does seem to offer kind of return and diversification appeal, which is interesting. We're diversified also away from we're not just focused on US equities. So we've got an overweight position in UK equities where we see value as a little bit more attractive, and some of the other parts of the world as well. And also more broadly than that, we want to hold assets which, in the world where stocks and bonds could go down together, that might offer a little bit of insurance in those moments. So again, it's about mostly the sort of quite prosaic work of just making sure that we're constantly on top of the risks embedded in the portfolio, that you're always thinking about diversification, that you're harvesting the gains from your winners and all of that kind of sensible stuff that happily clients, have continued to trust us with for good reason. And like I say, I've joined an already very high functioning team, so I don't want to take credit for stuff that I had nothing to do with, but I'm very pleased to say that, we're just continually looking at ways we can improve outcomes That's a never-ending journey in investments. It's one of the lovely things about it. You can never stand still and say, we've got the recipe.
Absolutely. On that point, that not standing still, my takeaway from this is the difference between noise and fundamentals, sorting out myopia from true fundamental positioning and taking that 50,000-foot view. And I think that's a reassuring message at a time when, pick any of these topics, you can go down a rabbit hole to the point of not knowing which way to turn. So that's stability view over the long term, and having a team that's navigated that over many, many years, I'm sure is a valued asset for you.
I mean, it's cost me most of my hair to get to that stage, but yes, that is the benefit of having seen a lot of cycles and having a lot of people around us at work that have also seen plenty of ups and downs.
Well, you used, I don't know if you used the phrase moving feast, but certainly want to continue evolution here. I would love to come do this again at some point. I want to thank our listeners at home today, Will, but we have more employment data, inflation data coming, and maybe we can follow up shortly on how the SpaceX IPO landed, further escalation or not in the Iran crisis, what you're thinking about future portfolio positioning. But these real-time updates, I think, are important at a time when, to your point earlier about social media and technology, we have real-time visibility on what's happening in the world, but that shouldn't distract, of course, from our long-term investment ambition. So thank you for your time today.
Thank you.
I look forward to our next session. Thank you at home too.